This is a dollar bill I kept from a few years ago. It still looks the same. Same ink, same paper, same promise. But if I'm being honest, it doesn't buy the same life anymore. And that's the part most people miss. Your money doesn't have to disappear from your account for you to lose it. Sometimes it just gets weaker while you're standing still. Today I'm going to show you how that hidden tax works, why it keeps hitting families without a vote, and why gold and silver may help protect you from part of it. But the most important part is near the middle, because that's where most people make the wrong move with precious metals. Not because they're dumb, but because they're desperate. Today is Monday, May 25th in New York. Before we get into it, comment what day and date you're watching from, because I want to see how many people are dealing with this same problem in real time. If you value this kind of breakdown, subscribe and comment Our John AG. That tells me you're here for the real work. Before we go further, I need to set the table here. This isn't a fear video. I'm not here to tell you to run into a coin shop and trade your whole life for shiny metal. That's how people get hurt. What I want to show you is simpler and honestly more uncomfortable. Inflation is not just higher prices. Inflation is a transfer. It moves purchasing power away from people holding cash and toward the system that created more claims on the same real goods. That's the game. And once you see it, you can't unsee it. So here's what nobody tells ordinary savers. The skills that make you feel responsible in normal life can quietly punish you during inflation. Saving cash feels safe. Avoiding risk feels smart. Waiting for things to get cheaper feels patient. But if the currency keeps losing buying power, patience without a plan becomes an expensive habit. You don't have to become a speculator. You just have to understand what you're actually holding. Let's start with the first truth. Inflation is a tax that doesn't arrive in an envelope. Nobody sends you a bill saying, "Congratulations, your grocery money is worth less this month." It just happens. The rent renewal comes in higher, insurance gets heavier, food packages get smaller, repairs cost more, and your paycheck may rise, but usually after the damage has already been done. According to the latest public inflation numbers, prices are still climbing enough for households to feel every week. That means the headline is not the whole story. Your personal inflation rate may be worse than the national average if the things you buy most are the things rising fastest. And that matters because inflation doesn't hit everyone evenly. It punishes people who have fewer assets, tighter paychecks, and less room to make mistakes when prices jump again at the worst possible financial moment. And this is where the hidden tax gets ugly. If your income rises just enough to chase prices, you may not be richer. You may simply be earning more dollars to buy the same life. But the tax code sees those extra dollars first. Some brackets are adjusted, yes, and that's the part people skip. But not every threshold, fee, deduction, local rule, or benefit formula moves perfectly with your real cost of living. So inflation can still push families into worse financial positions even when their lifestyle didn't improve. That's the trap. You feel like you're running harder, and somehow the treadmill still moves backward. Now let's talk about government spending, because this is where people start checking out. Don't check out. This is the part that touches your kitchen table. When Washington spends more than it collects, that gap has to be covered somehow. It can be covered with taxes now. It can be covered with borrowing. It can be covered with money creation directly or indirectly. But there is no magic drawer behind the Capitol where free wealth sits waiting. Somebody pays. Maybe today, maybe through future interest, but somebody pays. Based on the latest publicly available budget projections, the government is still running low trillion-dollar deficits, and the national debt is around the high 30 trillion range. Say that slowly, high 30 trillion. That number is so large it almost becomes meaningless, and that's dangerous. When numbers get too big to feel, politicians learn they can hide behind them. But interest does not care whether voters are tired. Interest keeps compounding. And when more tax revenue has to go toward paying interest, less room is left for everything else. Here's the second truth. Borrowing is not free just because it feels delayed. If the government borrows today, it creates future payment obligations. When rates are low, people ignore it. When rates rise, the bill starts making noise. That's why higher Treasury yields matter. They're not just a Wall Street chart. They influence mortgages, credit cards, business loans, and eventually the federal budget itself. The debt pile becomes heavier when the price of carrying it rises. Now, this is where gold and silver enter the conversation. Not as magic, not as religion, not as a guaranteed profit machine. Gold and silver matter because they are outside the promise system. A dollar is a liability, a bond is a promise. But a gold coin in your hand is not someone else's debt. Silver is the same idea, just with a different market personality. And in an age where every institution seems to solve problems by issuing more paper, something that cannot be printed has a different psychological weight. But listen carefully, because this is the part people skip. Gold and silver do not save you from every tax. If you sell metals at a gain, tax rules can still apply. In many cases, physical precious metals are treated under collectible rules, and long-term gains can face a higher maximum rate than regular stock gains. States can have their own rules too. Some states have reduced sales taxes on bullion or discussed stronger recognition of metals as money. But that does not mean you get a tax invisibility cloak. Avoiding inflation damage and avoiding legal taxes are not the same thing. That's truth number 3. Metals can protect purchasing power, but they cannot protect bad planning. If you buy emotionally after a huge price spike, ignore storage, ignore taxes, and then need to sell during a pullback, the metal didn't fail you. Your plan failed you. That's not an insult. That's just the cost of confusing fear with strategy. People who do well with hard assets think in years, not panic windows. They use metals as balance, not as a lottery ticket. Let's talk about pandemic money, because it taught a lesson that still matters. A lot of households received direct checks, expanded benefits, and emergency support. Some of that helped people survive a real crisis. But the other side is just as real. When money and debt flood a system with damaged supply chains, the bill does not vanish. It often comes later, through higher prices, higher rates, and a more fragile economy. The check feels simple when it arrives. The repayment is scattered across rent, groceries, fuel, insurance, and taxes. That's why it is so hard to see. Now here's the counterpoint, because we have to be honest. Inflation is not always caused by one villain pulling one lever. Energy shocks matter. Wars matter. Supply chains matter. Labor shortages matter. Corporate pricing power can matter. But money and deficits decide how much oxygen the fire gets. If prices jump in one area, that's a price shock. If the whole system keeps adjusting upward, that's something deeper. So when people say gas prices are inflation, that's not exactly right. Gas prices can feed inflation and scare consumers. But a higher pump price alone is not the entire disease. It's a symptom, sometimes a trigger, sometimes both. Truth number 4, the dollar can be dominant and still lose value at home. Those two things can exist together. The United States can have the world's deepest treasury market, the reserve currency, and the most important financial plumbing, while your grocery bill still gets worse. Dollar dominance does not mean your personal purchasing power is protected. It just means the system has more runway than weaker currencies. And more runway can be good, but it can also allow bad habits to continue longer. That brings us to the part nobody likes saying out loud. A currency can survive while savers get punished. Survival is not the same as fairness. A system can keep operating, banks can open, markets can trade, politicians can give speeches, and your cash can still quietly lose ground. That's why central banks, institutions, and long-term investors keep paying attention to gold. Recent global gold data shows demand supported by investors and official buyers looking for diversification. They are not all preparing for the same disaster. They are preparing for uncertainty. But silver is different. Silver has a monetary history, yes, but it also has industrial demand. That makes it more volatile. It can move harder in both directions. It can act like a precious metal one month and industrial material the next. That's why silver can be exciting and dangerous at the same time. If gold is the seatbelt, silver can sometimes feel like the engine. It means they serve different roles, and you need to know which risk you're actually buying. Truth number 5. The real protection is not the metal itself, it's the behavior the metal forces. When you buy physical gold or silver, you slow down. You think about storage, you think about spread, you think about why you own it. You think about what kind of emergency would make you sell. That friction can be a feature. It stops you from treating long-term savings like a casino app. But too much friction can hurt if your money is hard to liquidate. Balance matters. So what does a reasonable person do? First, don't confuse cash with safety. Cash is useful. You need it for bills, emergencies, but cash over long periods can be a melting ice cube if inflation stays above the return you're earning. Second, don't confuse gold with income. Gold doesn't pay rent. It doesn't send dividends. It mainly sits there, and that is both the weakness and the strength. Third, don't confuse silver's upside with certainty. Silver can surge, but it can also punish late buyers. Truth number 6. The goal is not to beat the government. The goal is to stop being financially naive. You cannot control deficits. You cannot control the money supply. You cannot control energy shocks, rate decisions, or political promises. But you can control how exposed your savings are to one currency, one bank, one asset class, and one story. That's where gold and silver can fit. Not all of your life, not rent money, not emergency funds, but a measured piece of a broader plan. Now let's make it practical. If you're considering metals, know your why before you buy. Is it emergency diversification, long-term purchasing power, portfolio insurance, family wealth storage, a hedge against policy mistakes? Those are different reasons. And different reasons require different sizing, different products, and patience. A person buying a few coins for emergency resilience should not act like a futures trader. A person buying through an account should understand counterparty risk. A person buying physical should understand premiums and storage. And here's the question I want you to answer in the comments. What has made inflation feel most real in your life? Groceries, rent, insurance, energy, or something else? The official number is one thing. Your lived number is another. Let's summarize this. Inflation is a hidden tax because it reduces purchasing power without a direct vote. Deficits matter because unpaid spending still lands somewhere. Borrowing matters because interest becomes tomorrow's squeeze. Gold and silver matter because they are not printed promises. Taxes still matter because metals are not outside the law. Timing matters because fear is a terrible financial planner. And balance matters because no single asset saves a person from every kind of risk. So here's the move. Don't watch prices all day hoping for a perfect entry. Build a framework. Decide what role cash plays. Decide what role productive assets play. Decide what role metals play. Then act slowly enough that you can live with it. The people who survive inflation are usually not the loudest. They're the ones who respect math before the crowd is forced to. Before you go, subscribe if you want more straight financial breakdowns like this, and comment "Our John AG" if this helped you see the hidden tax more clearly. Also, if you're successful, share your success story so others can stay motivated. And remember, this is for education and perspective only. I'm not your financial advisor, and this is not personal financial advice. Use this as a starting point, then make decisions based on your situation, risk, and qualified guidance when needed.